Coming up on the Wheelhouse Retirement Show, we'll tell you why tax planning in retirement is more than just knowing what bracket you're in, and how your income and Medicare can figure into your tax plan. Also, in this week's planning tip of the week, the one thing your retirement plan may be missing. The Wheelhouse Retirement Show starts now.
Retirement is more than a destination. It's a journey that starts with a dream. A vision for the way you want to live, recharge, and give back. To get there, you need a plan to make your retirement dreams come true. Now in its second season, the Wheelhouse Retirement Show provides you with the essential strategies needed to plan your ideal retirement. From income planning and wealth management to strategies for taxes, long-term care, and leaving a legacy, Rishi Ghosh, Anthony Stryker, and the team at Wheelhouse Advisory Group provide modern solutions and comprehensive plans for your journey to and through retirement. This is the Wheelhouse Retirement Show.
It's great to be back with Rishi Ghosh and Anthony Stryker of Wheelhouse Advisory Group. Good to be with you guys.
Great to be back.
Ready for a show about tax planning. We talk about that a lot as being an integral part of retirement planning. Let's give our viewers a refresher in terms of why it's so important.
So, Amy, in terms of total retirement planning, there are essentially three different pillars. There's investment and income planning, tax planning, and estate planning. And one of the principles that the practice was built on was total retirement planning, getting all three pillars to work together to have a secure and worry-free retirement. And one of the biggest reasons why our practice continues to grow the way it is with the right wheelhouse clients is through tax planning strategies. Now, I've said this for a while now, but a lot of people, when they think about taxes, they strictly think about filing their taxes, getting all those 1099s and W-2s together, giving them to a CPA or using TurboTax like our family utilizes, and filing their return and hopefully getting a little bit money back or maybe paying a little bit of money. But we are talking about tax strategy and how exactly to take these 401ks and IRAs where we've built our net worths up throughout the last 10, 15, 20 years of the accumulation phase of our life and turn that into our real net worth, which is true dollars in our pocket. The most sophisticated clients that we have are the ones that can look at that 401k and see $1.5 million in it, but they knew their true net worth. They know their true net worth is maybe $1.2 million. And they want a strategy on how they can get that $1.2 million in their pocket prior to tax rates going up, and now maybe only getting $1.1 or $1 million in their pocket.
A lot of people focus on what tax bracket they're in when it comes to tax planning. And I know there are other things that we need to be considering in terms of that long-term portion of it.
That's correct. There's really three main things that we focus on when we put together a proactive tax strategy for someone. And you hit on one, and that's tax brackets. So when we talk about the tax brackets, we're talking about what do current tax brackets look like and what we believe future tax brackets are right now. And we've talked a lot about in other shows about how this is historically low tax rates we are in right now. And so we look at, if we pull a certain amount through Roth conversions or tax planning, what marginal tax rate will I be at, and effective tax rate as well, meaning the average between all of the high and low tax brackets all my incomes fall under. But if we just focus on that, we can be surprised by the other two facets that should be in a total tax planning structure. And those are Medicare costs based on what incomes I have and all the tax planning I do. What are my Medicare costs looking like? And then also Social Security taxes, specifically state to state. What do different types of tax returns look like if I file married filing jointly versus married filing separately? What will my taxes be on my Social Security costs? So we have to really look at all three of those things when we're putting together a proactive strategy to make sure that we're not surprised by those things, that we just focus on one or the other.
Okay, let's dive a little bit deeper into Medicare costs. When someone starts Medicare at age 65, how do they know what their premium will be? How can tax planning maybe impact this?
So a lot of people don't realize Medicare premiums or costs for Medicare are based on your income 2 years prior. Meaning, let's just hypothetically say that you turned 65 in the year 2020. Based on your income in 2018, 2 years prior would determine how much you actually pay in premium. So as Anthony mentioned, and the financial planning team at Wheelhouse does a phenomenal job of this, is a lot of people take the simplistic approach when it comes to tax strategy, which is, what tax bracket am I in? Let me pull as much money in that bracket as possible so I don't go into the next bracket. But you also have to dig deeper. You have to look at Medicare premiums as well. Medicare premiums are what we call cliffs, not escalators, meaning if you go even a penny above a certain threshold, for example, in the example we brought down, if you go even a penny above $182,000 of income, your Medicare premium then jumps from $170 a month up to $238 a month. So it's quite an increase per person per month. So we have to dig deeper than just brackets, income brackets, but also into Medicare brackets as well to see, does it make sense to jump an income bracket or a Medicare bracket in order to get a larger chunk of your portfolio converted to tax-free assets.
A lot to think about, and all of this, of course, goes into the overall tax planning. Let's bring it back to that. What does that look like? How does it all work together?
And generally, that tax planning really looks like converting money from those IRAs to those Roth IRAs, which in the years that you do that, that's going to raise your income by a certain amount of dollars, however many dollars you convert from that IRA to Roth IRA to get it start to growing tax-free. And what's kind of gets confusing here is that the tax brackets are all based on your taxable income, which is after things like the standard deduction, while these Medicare premiums, these Medicare brackets or cliffs, are based on your modified adjusted gross income. So there's a lot of kind of trial and error into, if I go into this bracket, what will my Medicare premium be? If I stay in this bracket, will I pay a lower cost in Medicare? And lately with Wheelhouse clients, we've been a little bit more aggressive when it comes to doing more Roth conversions. 5-10 years ago, we were talking to clients and they weren't wanting to pay as high of Medicare costs, but with the debts and deficits in this country, for some families, it has made sense to, pull more money from these IRAs, convert them to Roth, even if it means in the short term, we are paying more in Medicare. But again, we'd never want our client to be surprised by what they might pay in additional Medicare premiums.
So for like my parents, for example, we use what we call a staggered tax planning strategy approach. 1 year I may draw them to the top of the 22% bracket. The following year they may jump up to the 24% bracket. So we go 1 year higher, 1 year lower, 1 year higher, 1 year lower. And the reason why we do that is my dad, which I've talked about him multiple times on the show throughout the years, is he's a very numerically, he knows his numbers. He knows what's going on in the portfolio, and he's determined that he believes it's better for him to convert his investable asset while him and my mother are alive prior to passing it on to whatever is passed on to me and my sister during that time frame. So the average and effective cost is 1 year his Medicare premium is a little bit higher, 1 year it's a little bit lower. But the average cost between the highs and low years, we've determined that that's a better rate than waiting till income brackets go up in the future, tax rates go up in the future, and Medicare premium costs also go up in the future. So taking advantage of it today prior to it going into a worse situation.
All right, very interesting. The dad effect, there it is. All right, thank you so much. There's a lot to know when it comes to Medicare and tax planning. We'll keep the conversation going. And later in our planning tip of the week, why a written retirement plan could be the key to your successful retirement. Stay tuned. The Wheelhouse Retirement Show continues right after this.
Just when you may want to forget your age, Uncle Sam says not so fast. Knowing your age is more important than ever when it comes to taking your required minimum distributions, or RMDs. Legislation just changed the age requirement, and not accounting for that could impact your retirement plan. It could be key to not overpaying on taxes in retirement. So remember, when it comes to RMDs, age is more than just a number. Before your next birthday, call today to secure a strategy for the RMD age change and your retirement.
We're back with Rishi and Anthony, and we're talking about how Medicare can fit into your tax strategy in retirement. Let's talk about what retirees need to know about their income and Medicare, and when they're putting it all together with tax planning.
Well, we wanted to bring up this Medicare chart again, and just to remind our viewers that, because it seems sometimes nonsensical that the income that we have 2 years ago is what affects our Medicare premium today. So just as a basic example, if a couple was to go over $182,000 in modified adjusted gross income, their Medicare premium and that was in 2020, their Medicare premium for 2022 would shoot from $170 to just over $238. So over a 1-year period, multiply that by 2 people in 12 months, that's almost $1,600 that they're paying more for Medicare costs in 1 year. So I just wanted to remind our viewers that these don't work like the tax brackets where they're progressive. These are cliffs. You go $1 over and you're paying a higher Medicare cost. So we really don't want anyone to be surprised by those and want people, Medicare is a constantly changing program, so we want to make sure the most recent and up-to-date information is out there.
If someone retires before they're eligible for Medicare, what about a Roth conversion? Would that affect their Medicare premiums?
Actually, for our clients that retire before Medicare age, it actually gives them kind of a sweet spot, as we call it, where generally speaking with tax strategy, you have to worry about income brackets, Medicare brackets, and how it affects your Social Security. Well, if you're not Medicare eligible or not 63 yet, where your income will affect your Medicare at 65 years old, it gives you actually the opportunity to think about maybe doing more aggressive Roth conversions during that time frame. I remember a longtime client, when they initially came to us, they retired at 58 years old, and they said they wanted to take a very aggressive strategy between 58 and 62 years old in converting their money as quickly as possible. They said, we don't want to jump up to the 32 or 35% bracket, but we are very much looking at maybe filling up the 24% bracket. And it worked for their situation just because it didn't affect their Medicare premium. They said, when I get to 63 years old, then I want to be a little bit more strategic because I want to make sure my Medicare cost doesn't also go up during that same time frame.
Let's move from Medicare to Social Security. What do we need to know? What should we know about benefits and taxes?
The first thing I want people to know is a question we get from so many viewers and a lot of clients too, especially when they're about to take Social Security. Is my Social Security taxed? And that's a big question because it did get taxed on the way in, and for a while it was never supposed to be taxed on the way out. But Social Security is taxed in retirement up to a certain point. So on the federal level, if you're filing an individual or single tax return, if you make from $25,000 to $34,000 in total income, you may have to pay income tax on up to 50% of those Social Security benefits. If you make over $34,000, then almost all of your benefits are taxed at where 85% of those benefits do figure into your taxable income. For married couples, from $32,000 to $44,000 of income, they hit that threshold where 50% or so of their Social Security benefits are taxed. But if they make more than $44,000 of income, which a lot of our retirees at Wheelhouse do, especially if they're getting a strong pension, taking money from their accounts, they're also in the situation where up to 85% of their benefits will be taxed. So it's taxed on the way in and on the way out, and it's important to know exactly how much of that figures into your end tax return.
I know Anthony brought up federal taxes. Let's talk about state taxes. How does that play into this planning process?
Well, this is really where the exciting part comes into with tax strategy, because based on state to state, your income tax on your Social Security, it changes. For example, our clients on the other side of the river, Illinois, thankfully, they do not have to worry about a state tax on their Social Security. But for clients on our side of the river, our viewers on our side, on the Missouri side, your Social Security, the amount of state tax you pay on your Social Security is dependent on your income. So if you're a married couple and you make over $100,000 worth of income, now your Social Security will be taxed in the state of Missouri, in addition to the federal tax. If you're a single filer and you make over $85,000, now you're going to face Social Security tax. So the reason why I get excited about this is there are strategies out there to potentially save your money, and save some money in taxes when it comes to filing your return. Most people, if they're married, they only think about a married filing jointly tax return. But there's another option out there that sometimes works advantageously for families, and that's married filing separately. So for example, we brought a situation down here where a couple has Social Security income of $44,000, which we have highlighted, pension income of about $24,000. They're taking distributions from their account of $57,000, and they decided to do a Roth conversion to keep them within the 22% bracket, which puts their total income at $165,000. So with this example, because this married couple is above the $100,000 threshold, their Social Security is taxed at the Missouri state level. So their $44,000 of Social Security income is taxed at Missouri's 5.9% rate, or approximately $2,600. So that being said, a lot of people think, well, it is what it is. I want to do Roth conversions. I need money to pay my bills. I'm going to be above $100,000 of income. I have nothing else that I can do. But there potentially is, and you have to discuss with your CPA or your tax planner to make sure this makes sense for your family. But what we call a married filing separately return, where if I use the example of Mr. and Mrs. Smith, what happens as opposed to having $165,000 on a married jointly return? We split those incomes. So for example, if Mr. Smith has Social Security income of $25,000, no pensions in this example, and out of the $57,000 of family distributions from IRAs, we take $37,000 from his account and do $20,000 of the $40,000 of family Roth conversions within his IRAs. That puts his total income at $82,000. We split the other side of the family's income onto Mrs. Smith's tax return, which you can see her total income on the right side of the screen is about $83,000. Now, by doing a married filing separately tax return, the family still has $165,000 worth of income. We've kept each spouse below the $85,000 threshold, thus avoiding the 5.9% Missouri state tax on Social Security benefit, potentially saving this family $2,600 in the form of state tax.
And that's just over 1 year.
Yeah,
That's
great
over
example.
1 year. You extrapolate that out 5 years, 10 years, you extrapolate that out with Social Security going up, with the cost of living and tax rates going up. There's potentially tens of thousands of dollars. Maybe if you do it right, hundreds of thousands of dollars you could potentially save by thinking about these different types of returns in order to save money on your taxes.
Sounds like something to think about for sure. All right, thank you so much. Well, you've worked hard and saved well for retirement. So what could be missing from your strategy? Rishi explains next in our planning tip of the week.
Where would you go if you could go anywhere? What would you do if you could do anything? How would you fill your days? Who would you spend them with? When you retire, what will you explore? Let us show you how a complete retirement plan can open your world to endless possibilities. Explore your retirement.
For those of you who have met with us in person or have watched our show consistently, know that we are big believers that retirement planning requires a written plan. One of our clients had a different financial advisor throughout their life when their main focus was accumulating money for retirement. As they grew closer and closer to retirement, they had realized that they had seen plenty of their statements on how their investments or even long-term projections from their advisor, but they had never been given a written plan that explained in detail the different aspects of their retirement strategy. Being within 2 years of calling it quits at work, he and his wife had many new questions as they were getting ready to go through this major transition. Their portfolio was no longer just about getting a certain rate of return. They were wondering how their investments truly worked and what fees were associated with those investments. They wanted to know when they retired, where was the best place to take income from for expenses that weren't covered by their pensions and Social Security. There were moving parts in their plan that required a written document that was consistently updated and used everyday terms to help them understand how all the different facets of their portfolio helped them reach their goals. It is because of clients like these that Wheelhouse Advisor Group started writing out our clients' retirement plans and updating them each year. We call these plans our Retirement Navigator. For a new client at Wheelhouse, we take the first 3 meetings to uncover a family's goals and begin understanding their risk tolerance, as well as how they may be able to add value to their situation. Through meetings 4 and 5, we present and fine-tune their Retirement Navigator. The document starts by outlining the main goals of the family and the overall planning principles that we are using to help them reach these goals. We then go on to discuss their risk allocation and talking about how much risk they're willing to take based on our conversations with them up to that point. Past that, our financial planning team writes out details of the family's investments or proposed investments to help reach their goals. We go through with the client as a conversation, reading through the plan with them and making sure they understand the pros and the cons of each investment within their plan. Once the investments are covered, we rate out what our recommendations are for a specific income plan for the family if they are retired, as well as any proactive tax planning measures that we are recommending for them. If the client is over the age of 72, we also make sure that their required minimum distribution amount is listed for them so they are not surprised by that at any point. Finally, we list out the fees the family is paying for their planning in a dollar amount and as a percentage of their overall portfolio. Writing these plans out for our clients takes time and sometimes takes a few tries and communication with our team to make sure they are accurate. The feedback we have gotten from our clients regarding their retirement navigator tells us they find true value in these plans as it helps them understand many different facets of their retirement strategy all in one document. In our opinion, having a specific written plan is a huge difference maker when it comes to having confidence in your overall retirement picture. Don't have a written retirement plan? Give us a call. The Wheelhouse Retirement Show continues next.
Have you saved enough to retire? It's one of the most common questions we're asked at Wheelhouse Advisory Group, and you deserve to know. The answer might mean that you can retire earlier than you ever imagined. You've worked and saved for years, now it's time to make your savings work for you. Our team can help you discover how to generate income you can't outlive, plus ways to fight taxes, inflation, and the rising cost of healthcare. Don't delay. Get your retirement income questions answered so you can enjoy the retirement you deserve. Schedule a complimentary 30-minute strategy call now.
Back with Rishi and Anthony, and we're talking today about the three main components to creating a long-term tax planning strategy, and that of course includes tax brackets, Medicare cost, Social Security taxation. How do you put all of this together to help your clients figure out what's most important to focus on? Because there's a lot that goes into it. You've really given a lot of information today.
It's comprehensive retirement planning. It's determining what are the goals for the family and what is the best way to execute a plan to get to those goals. Some families, their goals are, hey, I want to pay as little as possible in health insurance costs, so I want to keep my taxable income as low as possible. If that's the strategy, we have to figure out an income and an investment strategy in order to make sure we don't generate them too much taxable gains in order to keep them in lower brackets. Other clients, like I mentioned earlier, their goal is before their Medicare premiums are affected, they want to convert as much money from IRAs to Roth IRAs as possible, where they may have to jump one or two brackets, but it's more important to them to get larger chunks of their 401ks tax-free rather than waiting for the future. Other clients say, you know, leaving money to the next generation may not be the most important thing to me. Making sure I don't become a burden on my children may be more important to me, but I know if we do this properly, this money is going to flow into my next generation. So how do I make sure I don't leave them a big tax bill or a problem with accounts all different places where they have to worry about an estate plan?
You provide tax planning for your clients each and every year. Let's go through what that process looks like.
So for a Wheelhouse client, they can expect at least 2 meetings a year with their advisor. We have a kind of a 6-month checkup and then also an annual review. And they all know or should know, we try to communicate exactly what that annual review month is, and that's when we go over all facets of the portfolio. We've talked a lot about our comprehensive written plan called our Retirement Navigator. When we go through, especially for someone who's deep into tax planning, a retiree, when we go through that Navigator, there's a tax planning section in it. And in that section, we go through what their mock tax return will look like for that year based on what their incomes are, Social Securities, pensions, and what they're taking from their retirement accounts. And we say, okay, this is what your income's going to look like, and this is about where you'll be as far as tax brackets go right now, and what Medicare costs will look like too, if we stay at this income. And then we say, on the low side, we write out, this is the Roth conversion that we believe you should at least think about doing this year. Converting money from your IRAs to your Roth IRAs, in the least, we should at least go with this amount. And then we say, this is the more aggressive side, this is our high side recommendation. And each, for the low side and the high side, we talk about what that potentially will do to their Social Security taxes, what it might do for their Medicare taxes, and sometimes it takes a few more phone calls to really understand the implications or fine-tune the numbers to make sure they understand each of those recommendations, and we figure out which one, and we end up executing that tax plan, or if they don't want to, we end up tabling it for the next year. But it's something we always bring up in those annual reviews and make sure that we walk them through that as slow as possible to make sure it's understood on both sides of the table.
You've talked a lot about Roth conversions. What if this is something that maybe a client isn't interested in doing?
That's absolutely no problem. As fiduciary advisors, we should always bring a strategy to the table, but it's completely up to the client, whether they want to execute that strategy or not. Tax planning doesn't only mean Roth conversions. Tax planning also could be a strategy to help pay down debt. If a client, let's just say, comes to us and they have $150,000 left on their home and they said, I want to figure out what's the most tax efficient manner to get this house paid off, tax strategy can entail how exactly do we take money from different tax classifications to keep them in lower brackets but give them the liquidity and the cash in their pocket to maybe pay off a debt. We have a lot of our clients as they get into retirement and they truly finally realize this is going to work, they might start focusing on grandchildren. I want to make sure I have the liquidity and the income plan in order to, if I want to fund a 529, I want to get that money into the 529. So Roth conversions, even though they're our favorite facet of tax planning, isn't the only type of tax planning you can do. It's how to harness your situation and how to add fuel to that fire in order to make sure that Uncle Sam gets their share, but as little of that share as possible.
Are your clients concerned that the government might come in and change the rules on these Roth IRAs, as sometimes happens?
We've had clients who are concerned with that. We've also had viewers call into the show who ask that same question. And the answer on this is, although there is a concern, and there has been some legislation that's been proposed and really gotten nowhere near, passed, but there are some pieces of legislation that might go through in the next few years that could affect Roth conversion, especially for the ultra wealthy. However, from a practical sense, we really think of Roth conversions as a way for retirees to prepay their taxes, meaning from the government standpoint, that's where they get their revenue. If somebody is going to be willing to prepay their tax revenue to the government, I can't really see much of a way for Roth conversions in and of themselves to be stamped out, and we think they'll still stay a part of our planning. Now, if something like that were to ever happen, it is very, very unlikely, in our opinion, that dollars that are already in Roth IRAs will not be grandfathered into a rule where it says that those are no longer tax-free. So that's why we're talking about controlling what we can control today, the way the IRS laws and tax laws sit today, getting as much money as efficiently as possible into those Roth IRAs so they can grow tax-free. Again, these are hard-earned dollars in these 401ks and IRAs. We want to make sure that we take full advantage of them and they grow tax-free and stay tax-free for the retiree, for their spouses, and for their families for generations to come.
In addition, a huge advantage of Roth IRAs that we really don't talk too much about is the amount of money you have within your Roth IRA is not subject to those pesky RMDs, or required minimum distributions. So many of our clients dread that age of 72 years old where they'll get to the point the government will say, how much do you have in those IRA accounts? Based on your age, your spouse's age, and our actuarial table, you are forced to take out XYZ dollars. And most of the time when the government forces you to do something, it rarely works in your best interest, short run and long run. So the amount of money that you have in your Roth IRA is actually not subject to that calculation. It bypasses that calculation. Only the money you have left in pre-tax. So if you could put a strategy together where you can get as little as possible into that calculation, meaning getting your IRA and 401k either eliminated or reduced, it's another advantage to possibly helping you save money over the long run.
Really good information. Thank you so much, guys. If you're ready to develop a comprehensive strategy for retirement, don't delay. Reach out by phone or on the web to get started planning for your ideal retirement future. For Rishi Ghosh, Anthony Stryker, and the team at Wheelhouse Advisory Group, I'm Amy Sharp. Have a great week, everyone. We'll see you next time.